All right, welcome to today's Explainer. We're diving into a genuinely fascinating 12-year saga that literally changed how the global business world keeps score. We're talking about the long, high-stakes road to IFRS 15. You know, if you were looking at financial statements before 2014, revenue reporting was, well, it was total chaos. Identical transactions were reported completely differently, just depending on where a company was headquartered. Crazy, right? So today, we're going to unpack exactly how that chaos was finally fixed.
To make sense of this massive 12-year timeline, we're going to navigate 5 distinct acts: the Atlantic Divide, finding common ground, the industry backlash, 3 major compromises, and finally, the strategic quarantine. Let's get right into it.
Act 1. The Atlantic Divide, pre-2014 chaos.
Okay, so picture this. You're comparing 2 major airlines, or maybe 2 massive software companies, running the exact same types of transactions. Pre-2014, their top-line revenue numbers could look entirely different, purely based on their zip code. This incompatibility wasn't just a glitch, it stemmed from 2 drastically different philosophical approaches to accounting. On the European side, under IFRS, you had just 2 really thin, principle-based standards. That was IAS 18 for revenue and IAS 11 for construction contracts. Super simple, but honestly, maybe a bit too simple for a modern world full of bundled, complex contracts. Then, on the American side, under US GAAP, total Wild West, but in the completely opposite direction. You had over 100 pieces of fragmented transaction and industry-specific rules just piled up over decades, and neither side could just swallow their pride and adopt the other's framework wholesale.
Okay, let's dive into this. The gap between these 2 systems was absolutely immense. On one side of the ocean, Europe's IFRS was this peaceful landscape with basically just 2 solid, simple rulebooks. And on the other, America's US GAAP was a dense, towering metropolis built out of countless rigid rules. If you were a global business trying to bridge that gap, you were pretty much out of luck because the systems were fundamentally incompatible. Regulators finally realized that just slapping patches on these old standards, one industry at a time, wasn't going to cut it anymore. They had to build something totally new from the ground up.
Act 2. Finding common ground. 1. Revenue model. So the realization that they absolutely needed a unified approach forced the 2 major standard-setting boards to the same table. In 2002, the IASB and the FASB launched a hugely ambitious joint project. The goal was explicit: build a single common revenue recognition standard. They didn't just run a framework for different jurisdictions and capital markets. They needed one consistent language across completely different industries. One model, one language, one answer.
Fast forward to December 2008, and they published their very first discussion paper. This introduced 2 core concepts that would become the absolute twin pillars of the new standard. First up is the performance obligation, which in plain English is just a promise to transfer goods or services. Second is control, meaning revenue is only recognized when the customer actually obtains control of those goods or services. Now, these were never competing ideas. They were a pair from day one, brilliantly designed to track exactly what a company actually has left to deliver to its customer.
But as you might guess, while respondents broadly supported the core idea of identifying obligations and tracking control, 2 massive red flags immediately went up. The first was a timing concern. Looking at when each promised good is transferred sounds great in theory, unless that transfer happens continuously over time. The second was a huge control concern, especially coming from the construction industry. They were terrified, and I mean terrified, that an unclear definition of control might force them into completed contract accounting. Basically, a skyscraper builder wouldn't record a single dime of revenue until the entire building was totally finished and the keys were handed over years later. For them, this was literally an existential threat.
Act 3. The industry backlash. Friction escalates. Look, when industries feel their fundamental business metrics are threatened, they push back hard, and the friction here escalated incredibly fast. Following that 2008 paper, the boards issued an exposure draft in June 2010, and the response was overwhelming. They got hit with nearly 1,000 comment letters from across the globe. We're talking telecommunications, tech, pharma, manufacturing, you name it. The pushback was so intense that the boards had to take a highly unusual step. Nothing in their due process actually required them to issue a second draft, but the risk of unintended consequences was just too high. So unanimously, they decided they had to. They put out a revised draft in November 2011, which of course drew hundreds more letters.
You have to understand, this wasn't just some minor technical debate. We are 9 years into a project based on 2 ideas that almost everyone agreed on in principle, yet they're still stuck in formal rounds of public exposure.
Why? Because respondents were terrified that the new rules for identifying distinct goods or services would force them to slice their contracts into a million tiny pieces. It would create an absolute administrative nightmare that wouldn't even be useful to investors. The whole standard was at serious risk of just collapsing under its own theoretical weight.
Act 4. 3 major compromises. Practical solutions.
Now, what's really interesting about this is how the boards handled it. They realized that rigid enforcement of pure theory just wasn't going to work. Victory, and actually finalizing the standard, meant making some necessary practical compromises. The standard setters didn't just tweak the terminology here, they fundamentally altered how the rules applied. They needed the accounting outcomes to actually reflect the business reality on the ground for heavy construction, telecommunications, and intellectual property licensing.
Let's break those down. For construction, they created a dedicated 3-condition test. This allowed companies to keep recognizing revenue over time, completely saving them from that dreaded completed contract scenario we talked about earlier. For telecom, imagine trying to analyze millions of identical cell phone contracts one by one. Impossible, right? So they were granted a practical, portfolio-level approach to pricing. And for IP licensing, think software or media companies, they split the guidance into a right to use versus a right to access. This carved out specific rules for sales or usage-based royalties. These precise carve-outs essentially saved these industries from operational nightmares, and it paved the way for the final standard to finally be issued in May 2014.
Act 5. The Strategic Quarantine. Protecting the core.
But creating exceptions wasn't the only way they saved this whole project. We really have to look at standard setting through the lens of strategic product management, specifically the vital importance of scope. While construction and telecom were in the trenches fighting for compromises, 2 other massive industries were intentionally fenced off right from the start. Insurance contracts and rate-regulated activities were quarantined onto completely separate multi-year tracks. Why do that? To protect the core revenue project from stalling completely. You see, insurance already had an older standard, IFRS-4, acting as a placeholder while a new one was built. And rate-regulated activities? They had no guidance at all. Rolling that unresolved mess into IFRS 15 would have absolutely doomed the timeline. By intentionally keeping them out of the room, the core model could actually cross the finish line.
Okay, before we wrap up, I have to share this fascinating footnote with you. Despite everything we've just talked about, conceptually, the model the boards built isn't really a revenue model at all. Mechanically, it is an asset and liability model. Basically, a contract creates a net contract asset or liability that moves as the company performs its obligations. Revenue is simply the label they deliberately attach to an increase in that net position, just to make it easier for people to apply and understand in the real world. Under the hood, it is just an incredibly elegant piece of engineering.
Which brings us to the ultimate lesson of this entire 12-year journey. Quote, whether you're developing accounting standards or software products, long-term success often depends not on how many problems you try to solve, but on having the discipline to define what belongs inside the product and what does not. End quote. IFRS 15 aged well specifically because of its disciplined, well-defended boundaries. The hardest achievement wasn't what they managed to put into it, it was knowing exactly what to leave out so they could actually ship the standard. So I'll leave you with this to think about as you go back to your own work. Take a hard look at your current initiatives. What features, endless debates, or peripheral problems you need to strategically quarantine right now in order to ship your next big project on time? Because sometimes building the ultimate solution means knowing exactly where to draw the line. Thanks for joining me on this explainer, and keep that discipline in mind for your next big launch.